thought leadership from PwC.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. Thanks for tuning in to another episode of our series focused on the SEC's climate proposal. This week, we're talking Scope 1 and Scope 2 greenhouse gas emissions.
So the Greenhouse Gas Protocol is really helpful for helping you to design your approach, develop your boundaries, and help you determine what's in scope and what's out of scope.
That's my guest, Rich Goode. Rich is a PwC principal who focuses on helping companies evolve their ESG reporting and who has a wealth of experience with the GHG Protocol and the unique considerations that companies will face as they start to consider how to implement the proposed climate disclosure rules from the SEC. And even before the effective date of the SEC rules, this discussion may be relevant if you're involved in voluntary GHG reporting. So please stay tuned. Rich, thanks so much for joining me today to do a deeper dive into a topic that I think is on many, many people's minds these days, and that would be measuring and reporting GHG emissions. And maybe before we get into some of the detail and specifically addressing some of the things that are in the SEC proposal on climate change, why don't we take a step back and first explain what are GHG emissions, and then talk about the differences between the scopes.
Sure. Happy to be here today, Heather. Greenhouse gas emissions are one of those things that people have been measuring and reporting on for many, many years. And the organization that sort of wrote the book on greenhouse gas emissions, the World Resource Institute and the World Business Council for Sustainable Development, they came out with them over 20 years ago. And in an attempt to make them all things to all people, they decided to break them up into these three major categories: Scope 1, Scope 2, and Scope 3. And really, that really helps understand where the emissions come from. So Scope 1 emissions, first, are direct, meaning, and I like to use an analogy of your home. If you're home today and you turn up the heat, natural gas or oil-fired boiler started in your basement, you purchase that fuel, you're combusting that fuel to keep warm. That's your Scope 1 or direct emissions. Same with companies. If you have a big building, you're heating it, that tends to be Scope 1, natural gas. Or if you have a process, if you're making steel or cement or other things, we're using fossil fuel, natural gas, gasoline, diesel, other sort of fossil fuel, that ends up being your Scope 1 emissions. Same with vehicles. If you have a car, you put gasoline in it, you drive it around, you're buying the fossil fuel, you're combusting the fossil fuel, that's your Scope 1 emissions. The next phase, Scope 2 emissions, they just simply call indirect. And by indirect, they really mean the emissions are happening somewhere else, but they're happening for you. So right now on this podcast, I have some studio lighting, I have my PC here in front of me, I have laptops and so forth. That electricity is not generated here on site. I don't have solar panels directly atop my house, but there's a power company not too far away. They're generating that electricity on my behalf. So that's Scope 2 emissions, indirect emissions. There are other things like chilled water and steam, and those are a little less common. But in general, it's created somewhere on your behalf.
Well, I was just going to ask you a question, and this is one actually I emailed you a question about it a few weeks ago because I was trying to dig into it. First, can you explain when we say GHG emissions, sort of what's in scope in terms of which gases are in scope? Mm-hmm. And then I have a follow-on question once we run through that.
Sure. So by greenhouse gas emissions, what do we mean when we say greenhouse gas emissions? There are many. There are literally thousands of them. However, for our purposes here, I'll break them into two categories. I'll call them the big three, and that's carbon, methane, and nitrous oxide. So every time you start your car and you see the emissions pop out the tailpipe, most of it is CO2, carbon, some of it is methane, and a very small amount is nitrous oxide, N2O. It's very small, but it's also a very potent greenhouse gas. It traps a lot more heat than, say, CO2. So those are the big three types of greenhouse gas emissions. Then there are others. So there are perfluorocarbons, chlorinated fluorocarbons, something else called SF6, and other types of what I'll just call high GWP or high global warming potential emissions. You'll see these things in refrigerants, specialty chemicals, fire extinguishers, chemicals that, if released into the atmosphere, do happen to trap heat and are big causes of global warming.
All right. So, Rich, that's super helpful. Let me get to the question that I actually asked you, because I live in Southern California, and obviously smog is a big issue here in Southern California. So one of the things that's actually heavily regulated are NOx emissions, which I noted are absent from your list. So why are those considered separate?
Largely because greenhouse gas emissions are focused on the types of emissions that trap heat. They tend to be invisible. They tend to be lighter than air. They rise into the atmosphere. Sometimes they fall. So a lot of our greenhouse gas emissions are captured in trees, through photosynthesis, also soil and oceans. But those emissions that don't end up being trapped in sort of terrestrial heat sinks end up in the atmosphere. NOx, or nitrogen oxides, those tend to be smaller molecules. Now, nitrogen and N2O, that's a majority of the air we breathe. It's nitrogen and oxygen. It doesn't have a GWP associated with it, a global warming potential, but it does have particulates. And these small particulates are harmful if inhaled into the lungs. Oxides of nitrogen tend to hang around sea level, and that's what contributes to smog. So it's more of a human health impact than a global warming impact, and it tends to be regulated heavily on a state-by-state level.
That's very helpful. So you're saying when I'm driving into California and I can't see the mountains, that's because of nitrogen oxide is distinguished from nitrous oxide, which is in the scope of the GHG requirements. All right. Well, that's a total aside, but I do think it's helpful because we hear so much about regulation of NOx, and it's interesting because it's a totally separate issue. That's our sort of air quality we're talking about, not climate change.
That's right.
All right. So that was a sort of, like I said, an aside. So there's another type of GHG, which is scope 3. We're going to hit that in a separate podcast. So I don't want to talk about that anymore today, but let's dig a little deeper into these scope 1 and 2, and maybe starting with scope 1. And you talked about sort of burning fossil fuels and how even as individuals we can do that. So when I think about it from a company perspective, I come from power and utilities. Clearly, it's very straightforward. I run a utility. I'm burning gas or coal or some other fuel generating power. So that's creating scope 1 emissions. I imagine large manufacturing facilities would also have, similar. But what other types of companies really need to think about much in terms of maybe material, scope 1, and then what else might come in just in general if I'm measuring scope 1?
So you're right that utilities their emissions tend to be heavily favored around scope 1. So you really correctly point out you're burning fossil fuel to boil water, to create steam, to spin a generator, and that's where the scope 1 is there. But I think there's a few other major industries that are caught up in scope 1. So what I call basic industries. So if you're in oil and gas, you're doing exploration, you're out conducting fracking operations in fields, you tend to be using fossil fuel to create local electricity, or in the case of, say, steel production, you tend to use coal, which is dried out and baked. It's called coke, along with limestone and iron ore, to put into a blast furnace to reduce iron ore pellets into iron, then it's created into steel. So again, that direct burning of coke, which is a form of metallurgical coal, is also a scope 1. Same with things like making carbon black, or other rubber and other certain things which tend to use a lot of fossil-based inputs. And the third one would be transportation companies, because not only is this the mobile, it's called mobile combustion. So transportation companies, airlines, anyone using fossil fuel to power their vehicles. So big trucking fleets, every single airline, scope 1 is going to be an overwhelming majority of their emissions. Then finally, there's this area in scope 1 called fugitive emissions. And think of fugitive as an escapee, right? So if you're, say, a supermarket, maybe you're a big food distribution warehouse, and you've got lots and lots of refrigerators and freezers and chillers, and they all have refrigerant in them to keep them cold. This refrigerant is a very powerful greenhouse gas. By powerful greenhouse gas, if we say carbon, CO2, traps the equivalent of 1 unit of heat, certain refrigerants can trap 20 or 30,000 times more the amount of heat. So a very small release of refrigerant has an outsized impact on global warming compared to a small release of CO2, carbon dioxide. So fugitive emissions from either the manufacturing process, refrigeration, HVAC, those tend to actually have they're smaller as a percentage, but they have an outsized impact because the chemicals themselves trap and hold on to heat for so much longer than what I call the big three: carbon dioxide, methane, and nitrous oxide.
All right. So, Rich, a few questions coming from that, but let me start with one just based on the point you just made. So if I think about measuring emissions, and I think about some of these basic industries, including utilities, they will have in place these continuous emissions monitoring systems that they're actually measuring how much is being emitted from their plants. They're reporting that information to the EPA, and it's been heavily regulated for some period of time. Now, most companies don't have that on their buildings. And I'm guessing, I could be wrong, that like a supermarket does not have measurements in place to measure these fugitive emissions you're talking about. Airlines are not measuring it from their airplanes. So in those cases where you don't have the continuous emissions monitoring systems, I know there's guidance in the GHG protocol on how you do this, but I think it could be helpful to kind of walk through at least at a high level how you would think about measuring emissions when you don't have a measurement device in place.
So short of having dedicated emissions monitoring equipment, which, as you correctly point out, Heather, many companies don't, companies really are forced to look at activity data. And by activity data, I mean, do I have in a handy place source material that tells me, for example, for an airplane, how much aviation fuel did I buy? And if I know how much aviation fuel I bought, that's one handy way to calculate emissions, because I understand what the emissions from a liter or a gallon of aviation fuel is. But if I have more data, I know what types of planes I used, or what kinds of vehicles I used even, how many miles they traveled, then that's helpful in calculating emissions as well. And finally, if you don't have any of that data, but you have some financial data, and you know you spent $5 million, let's say, on fuel, and you know that there's an average cost of fuel, you can do some division to back into how much fuel you actually used. Now, that is in decreasing order of accuracy. Most accurate would, of course, be continuous monitoring. Second most accurate would be dedicated activity data. So I can take it right back to the invoice and see we bought 5 million gallons of aviation fuel. And short of that, at least I have some financial data that I could go back and estimate how much I may have purchased of that particular commodity, so I can then take my calculation forward. We should always strive to be as accurate as you can within the confines of what's realistic for your company.
Mm-hmm. Well, and I think in particular, we didn't dig into this earlier, but we're having this conversation in the context of the SEC proposals requiring disclosure of Scope 1 and Scope 2 emissions, and then for certain types of registrants to also get eventually reasonable assurance on those numbers. So if you think about producing information that's now going to be used by investors, the higher quality data, the better. And it's interesting because one of the questions in the SEC proposal is they are requiring various disclosures about methodology and assumptions and the like. And from listening to you, Rich, and kind of goes without saying, data always needs context, but it sounds like particularly in this case, those disclosures will be particularly important.
Yes, they'll be very important. And right now we're assisting many of our clients who have said, well, we've calculated our greenhouse gas emissions for years. Can you come in and perform a readiness? And all that means is looking at their greenhouse gas calculations as if we were performing an audit, but instead of an opinion at the end, we provide them with a report of gaps and opportunities for improvement. And almost to a one, every company has had challenges getting through a readiness assessment. For example, a company has said, here's our Scope 2 emissions for the year, and we want to go back and calculate look at source information and say, well, can you show me the invoices for maybe these 5 locations? We're just going to do a sample. And instead of providing invoices, they provide us with a spreadsheet that was manually prepared by someone who maybe in a different country, maybe English is a second or even third language, and that's fine. It's just this person was prepared this with very little context. How do we know that there weren't transposing errors there? How do we know this information is accurate? And we're unable to provide confidence in the form of an opinion that the numbers are correct. So really having companies go back, really good advice is on the data collection, which is, I call the easiest, most difficult aspect of greenhouse gas emissions. It's data collection. We understand what data we need, but getting it is very difficult simply because it's often in different languages. You may have a utility invoice collecting company on half your business, but on the other half, 4 or 5 ERP systems. Companies have grown through mergers and acquisitions, and there's no central source of truth, if you will, to get to source information. So to the extent that companies can identify where are most of our emissions and then start tracking down to get to source information to improve the accuracy, starting that today is a really good thing to do.
Yes, definitely a good reminder there. And I think particularly when we're talking again about trying to report this information, let me ask you then, kind of rewinding to our refrigerant example. So you talked about getting invoices measuring fuel and maybe miles traveled, which I have a question about that too. But how does that fit in with these fugitive emissions?
Sure. Fugitive emissions, generally the way to do that, at least when we're talking to our clients, I talk about materiality in terms of what is the percentage of your overall emissions. So if you are that large food distribution warehouse I was talking about earlier as an example, chances are the fugitive emissions from your refrigerants are material. They may be more than 5 or 10% of your entire greenhouse gas emissions. So going back and looking at vendor invoices, you'll always have vendors come in to repair and recharge the refrigerant every year. It's fairly straightforward. It's 6 pounds of R404 or 18 ounces of R212. Having that information, we're able to calculate it very precisely. So that information does exist somewhere. The hard part, again, is just finding that information so we're then able to calculate it. But for other companies, they may not have very material. So if it's a light manufacturing company, you're just maybe doing injection molded plastic devices and just shipping them, and the only refrigerant you have is a few window mounted air conditioners. Do I need to figure out how much and what type of refrigerant is in there? No, it's immaterial. I like to look at this from a business case perspective and say, well, where am I going to get the most bang for my buck? Time is money, and companies have to spend time to get this information, but where should I focus that time? And I look at the most material impacts.
All right. I think that's really helpful context. So then let me go back to the SEC proposal, because 2 pieces I want to focus on. One is that we talked about the fact that there's these 7 different gases, and the SEC is actually requiring you to disaggregate them and disclose them separately and then in total. And this is something you and I have communicated about. And I know you said that you did think this is helpful information, and there could be different regulations or otherwise over certain of these gases. But as you think about this requirement, particularly if you're talking to a company that's saying, this is too much information, I don't want to do this, blah, 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 all these different reasons. What is sort of your thinking in terms of why it is ultimately helpful to provide this information?
Sure. And I know for a lot of companies, that level of detail may not be useful, may not be decision useful. And we're unsure whether the SEC may change their thinking on that, or maybe say only certain industries. But the real reason behind it is not all gases are created equal. CO2 is always the baseline. That's the majority of emissions, particularly from fossil fuel. And I used this term earlier called GWP, global warming potential. And that simply refers to how much heat can that chemical or that molecule trap over time. And CO2 is always a baseline of 1. So all other gases are compared to CO2. That's why you often see greenhouse gas emissions expressed as CO2e, CO2 equivalent. But methane can trap 25 times more heat than CO2. Nitrous oxide, over 300 times more heat than CO2. And some of these refrigerants that I spoke of are up to 13 to 15 to even 30,000 times. So think about that. One single methane of a refrigerant is the equivalent to 30,000 molecules of CO2. So expressing your different greenhouse gas emissions allows users to see what type of emissions are you mostly putting into the atmosphere. So if you're an oil and gas company, or perhaps you're involved in hydraulic fracturing, there's a lot of fugitive methane emissions. And again, in California, and you mentioned them in sunny California, there was the largest methane leak ever from a well in California. And what was most dangerous about that was colorless and odorless. They could only see that on radar or a laser. And that had an enormous impact because of the potential of how potent methane is as a greenhouse gas. So I think for users, they want to see, well, where are your emissions, and is there a possibility to switch those to a different type of chemical with a lower GWP, so that you may still emit gases as part of your process or in your product use phase. However, it's a lot lower in terms of the impact it would have on the environment.
All right. So you partially answered my next question, which is the fact that there is this requirement to translate all of these into CO2 equivalents, so CO2e. And it sounds like, tell me if this is too simplistic, it's almost like if I didn't make that translation, it would be the same as if I was preparing financial statements and I had dollars and pounds and euros and yen and all these different currencies. And I just tried to kind of lay them all out and say, okay, user, go do what you will, versus putting them all in a common currency. That almost seems like it's the same. It's a currency of emissions that we're measuring here.
I think that's a great analogy, Heather. And that's exactly right. Because for somebody to say, well, my greenhouse gas emissions are 100,000 tons of CO2 and 4,800 tons of CH4, and, people are their eyes are going to glaze over before you get to nitrous oxide. So just simply saying this is expressed my carbon footprint in CO2e helps users compare and contrast with other companies.
All right. And then another thing you mentioned that I thought was so interesting is this thing with the refrigerant, that actually the information is there. You just have to know what information you're looking for. And I think the challenge for our listeners is, this is increasingly, as you're aware, moving into the finance function. They're now the ones that are going to have to be producing the information for the SEC reports. And again, it's sort of set this up at the beginning. A lot of these terms are new. A lot of the information is new. And it's not like they're dealing with accounting for a new contract where they know to go look, okay, I'm going to go look at the revenue standard. It's going to tell me, the general guidelines. The Greenhouse Gas Protocol provides guidelines, but I don't think at the level of detail you're talking about. And so there feels like there's a gap between maybe the information you need and what the finance team may even know to go look for. So how do you think about that when you're talking to companies?
Sure. The Greenhouse Gas Protocol, I really think that the folks who wrote that did a really good job of having a document that can be relevant to all companies in all industries. However, to be relevant to all companies in all industries, it's also sometimes frustratingly vague. Right? So the Greenhouse Gas Protocol is really helpful for helping you to design your approach, develop your boundaries, and help you determine what's in scope and what's out of scope. However, you need to add to that two things. One are emissions factors. So the EPA has emissions factors, the IPCC has emission factors, the UK has emissions factors. They're all fairly close, but there's enough subtlety and nuance between them that you want to pick the set of emissions factors that make most use for you. The second thing, and you won't find this anywhere, is context, company-specific context. Everybody has something that they do that's unique to them, their secret sauce, if you will, what makes them special. And that often is reflected in the way their emissions profile looks. So while the Greenhouse Gas Protocol gives you these handy guidelines called Scope 1, Scope 2, and Scope 3, and even subcategories between and among them, it doesn't say, if you are in a steel industry, you should do X, Y, Z. Now, there are sector supplements that you can look at. World Steel, for example, does have a sector supplement. That's an industry organization for the steel industry. And it basically says, if you're a steel company engaged in making steel, the way we like to see our greenhouse gas emissions expressed is in tons of finished steel, including Scope 1 and Scope 2. Now, that was a little bit different. Scope 2, a lot of steel companies say, well, I don't even report Scope 2 because it's immaterial. Well, increasingly, steel is being made with electricity instead of coal through this thing called electric arc furnaces. So they did have industry guidance. So now everybody who wants to report in the steel industry does have this industry-specific guidance. Doesn't exist for every industry, but it is helpful to investigate, see if there are some guidance parameters for your particular industry.
Well, and I think, Rich, an important point you note there is this question of materiality, because again, we haven't gone through this sort of interpretation of the SEC proposal, but at least on the surface, all companies are required to disclose Scope 1 and Scope 2. And so even if you historically have said, oh, my Scope 1's immaterial, my Scope 2's immaterial, you probably need to be digging deeper right now to really understand those numbers and come up with some calculations.
That's right. And as well as seeing if there's any gaps. So I had mentioned just a moment ago that there are these subcategories. So Scope 1 is called direct emissions, but there's stationary combustion, mobile combustion, and fugitive emissions. Scope 2, most people think it's just purchased electricity, but there's also purchased steam and chilled water. Now, again, more rare topics, but companies should do the homework now to determine if they're missing anything that might be substantial or material to their impact.
All right. And then we dug into Scope 1 and then we've jumped around a bit. Let's dig a little into Scope 2, to your point, that's not just purchased electricity. However, let's start with purchased electricity. So now I'm a company, got my invoice, and I know from my own experience, depending which utility you're buying power from, the mix of power is going to be much different. It could be renewable, it could be coal, it could be gas. The time of day even makes a difference. And I'm assuming we are not getting into that level of detail when we're calculating our Scope 2 emissions.
That's right.
But how do companies think about these calculations? Are they looking to their individual utilities? Are they looking to regions, or what are they thinking about?
Sure. So luckily there are lots of really good tools and emissions factors that exist out there. So here in the U.S., for example, there's a tool that's basically called eGrid. And depending on what your physical address is, it maps that address to the utility pool in that area. So, for example, New York has NIPOOL. Texas has ERCOT. Those are their eGrid's sub-region names. And the important thing to know is that a megawatt hour of electricity produced, let's say, in Portland, Oregon, is very different than a megawatt of electricity produced, say, in Kentucky. Kentucky is the heart of our U.S. coal country. A lot of the power plants there are still powered almost exclusively by coal. So 1 megawatt will have a lot of electricity produced in Kentucky will have a lot more emissions than something in the Pacific Northwest, which has an abundance of hydropower, or the desert Southwest has a lot of hydropower, or increasingly wind power. So the benefit to not just taking one flat emissions factor is that you get the benefit of lower emissions factors in different parts of the country. We worked with a company very recently where we performed some selective recalculations and we're off by 20% from what they had calculated their own emissions for. We dug a little bit deeper and they used one global average for electricity. And they were overstating their emissions from Scope 2 by over 20%. So simply by using the eGrid emissions factors, they were able to reduce their emissions by 20%. Now, they didn't really reduce their emissions. It's just that the actual emissions calculated end up being a lot lower by taking advantage of being located in areas with higher amounts of renewable energy in the local mix.
Well, and I think an important point here is if I go back to your earlier comments about like kind of digging into the data, you do have invoices. Someone in your company has an invoice that says how much power you're using in these different regions. And so there is going to be a big exercise to dig down and say, okay, how much am I buying in all these locations? Which e-grid factor should I be using? If you dig down and you get these invoices and you use the right factors, then you are more apt to be reporting a number that more accurately reflects your underlying emissions from that purchased electricity.
That's right. That's a great way to say it. Doing that due diligence to get that information and know where the electricity was produced is a really important step to getting it right.
All right, so let me ask a related question related to renewable energy credits. And for our listeners' benefit, the way the power markets work is if you generate power from a wind farm or solar or hydroelectric, depending where you are in the country, there's going to be some organization that's issuing that plant a renewable energy credit, one for each megawatt of renewable power. A lot of these projects are now selling directly to companies, these RECs. So you're buying your actual electricity from whatever your local utility, but some companies themselves may actually be buying a REC to say, hey, even though my utility is using coal, I am supporting a wind farm and getting the benefit of that. So how does something like that fit into these measurements? Can I take that into account when I'm coming up with my scope 2?
Sure, that's a great question. And renewable energy credits, you're right. They're simply a certificate which has attributes. And basically, this certificate states that 1 megawatt of clean renewable energy has been produced. And that certificate has value. So if a company decides, look, we have made a pledge to buy 50% of our electricity from clean renewable sources. There are a couple of ways you can do it. You can put your own solar panels on top of your roof, but generally most companies either don't have that capital or don't wish to spend that capital, or they may not even have enough space to cover all of their needs. So instead, they go to the market to purchase these renewable energy credits. Once you purchase them, if you want to take advantage of them, you have to retire them. You can't sort of take the benefit, then resell them. You have to take the claim and then retire them. A lot of companies will then, or let me pause there, because when you smiled, you maybe remember some silly things I've remembered companies did before.
Yes.
So once you purchase that renewable energy credit, you take ownership, and then if you want to take credit for that in terms of reducing your scope 2 emissions, then you retire that certificate, meaning it can never be sold again. It's a financial instrument. It has value. You retire it. That allows you to take credit for that.
All right. So, Rich, what's interesting here is that renewable energy credits, as we've described, they are, I don't want to use the word regulated, but there is broad understanding of what a REC is. They're generated in a certain way. They're tracked. To your point, they have to be retired. There's also now emerging carbon offsets. And these are different instruments. Maybe I own a forest and I say, okay, I can absorb this much carbon, so I'm going to sell you some carbon offsets, or I'm injecting into the ground, or there's all these different ways these carbon offsets are generated. However, they don't have the same sort of history and regular use that, if I have a renewable energy credit from California and one from Washington State and one from Texas, like we know all of those three things are talking about the same thing. If I have a carbon offset from a forest and from a field and maybe from another source, they may or may not be equivalent. So how do you think about carbon offsets and how do they fit into the SEC proposal?
Sure. So while a renewable energy credit has the attribute that 1 megawatt of clean renewable energy has been created, a carbon offsets attribute says that 1 ton of CO2 emissions have been removed or avoided from being emitted into the atmosphere. And in the European Union, we have the European Union trading scheme, the offset scheme, and carbon emissions are a way for companies and countries to meet their emissions reduction obligations per the Kyoto Protocol. Now, in other places, like here in the US, we don't have that sort of regulatory compliance right now. So carbon offsets are used to help offset other parts of your emissions. While renewable energy credits can only be used to offset your scope 2 emissions, carbon offsets are more flexible. You can use them to offset any part of your emissions. Though I would just say I wouldn't use carbon offsets to reduce my scope 2 emissions because renewable energy credits tend to be much less expensive. So sort of I consider them fit for purpose. RECs for scope 2, offsets for scope 1 and scope 3. Now, offsets are a little bit different than RECs in that RECs don't have this thing called additionality, meaning that it's okay that this renewable energy installation already exists. It's fine. It's up, it's running, it's creating renewable energy, and it creates these RECs that you can buy and use. Carbon offsets must have this additional barrier, this hurdle called additionality. Additionality means the project, meaning saving trees or injecting carbon or providing solar-powered cook stoves to developing nations. The project wouldn't have happened unless the income from the offset goes to the project. So let me say that again. A carbon offset, it has to have this thing called additionality, which means the project wouldn't have happened unless you bought the offset. So that's a little bit different than a REC. And as a result, because you're getting third parties to come in and provide validation that, for example, the forest is still standing, or you've made the switch from natural gas to solar, or what have you, that means they're more expensive. So carbon offsets can go $10, $15, $20 or more, and particularly if they're in demand from a regulatory perspective, they can. In Europe, we've seen carbon offsets run as high as over €50 per offset per ton, particularly when it's time of year to buy them to offset your emissions reductions for the year per the Kyoto Protocol requirements.
All right. I think that's helpful context. And I was actually thinking, Rich, while you were talking, we may need to do a whole separate podcast on offsets because I think we could dig a lot deeper. And again, I think because those are emerging, maybe less familiar to some people, particularly as we think about quality and valuation and the like. Let me ask you a few more questions, though. So I know I've heard you talk about GHG inventory management plans, and I think maybe we've peripherally hit on that today, but can you explain what that is and why you think that's important?
I really think the inventory management plan is one of the most important aspects of your carbon footprint, your greenhouse gas inventory. And I call it one of two things. I call it your who, what, when, where, why, and how document, or your winning the lottery document. Let me explain. The who, what, when, where, why, and how. Who's responsible for calculating your greenhouse gas emissions? What's included? How did you calculate it? What emissions factors did you use? What math? What's included? What's excluded? And why? Or the winning the lottery document. If you happen to have somebody who calculated your greenhouse gas emissions for you, and they wrote a good, fulsome greenhouse gas inventory management plan, and that person won the lottery and bought a private island and never returned any of your phone calls again, it allows you to calculate the emissions the same way next year. If I asked you, Heather, what did you have for lunch last Tuesday, you'd probably be hard-pressed to answer. How about if I asked you what was on your mind when you calculated Scope 2 emissions last year?
Yeah, there's no way. Yeah.
Right. So writing it down, it doesn't sound very glamorous or technical or comprehensive, but let me tell you, without having that document, there's no way you're going to pass an audit, and there's no way you're going to be able to calculate your emissions on a consistent basis if there's any changes in personnel. Even if there are no changes in personnel, like I said,
you could still have
remembering what you're still going to have issues.
Yeah. So the other thing that struck me when you're speaking is a lot of companies are trying to reduce their emissions, and so that inventory, having the right inventory, is also going to be helpful just for that in terms of looking to see maybe where you want to make changes, because it's going to help you see where your major sources are.
Yeah, that's correct. You really want to understand where the sources are. And there's an entire chapter in the Greenhouse Gas Protocol on data improvement. A lot of companies say, well, I just can't get this data this year. And that's okay. That doesn't mean you stop and put your pencils down and hope the SEC doesn't notice. You still have to start somewhere. Start where you are today. And if that means I can only calculate 70 or 80% of my emissions, that's okay. Just write down in your inventory management plan what you did, why you did it, and what's your improvement plan. And then you have the rest of the year to try to get that data or improve your data collection process to include those topics.
Well, and I think, Rich, to be clear, it's okay now. That's why you want to go through that now, because when you have to start doing your SEC reporting, you don't want to be in that position that you don't have all the information. So that actually is probably a great lead in to my final question for today. Recognizing we're going to have another podcast coming out next week, which is, what are the 3 tips you would give companies as they're preparing for this investment grade or investor grade disclosure of GHG emissions in their SEC filings? Or for private companies, we know there's a much bigger investor demand for this information too. So they should also be thinking about this.
Correct, because even if you're private, chances are many of your customers are big public companies that will be looking to you to say, can you help me understand what portion of your emissions are associated with my doing business with you? And if you can't, then maybe we won't do business with you. So this really does have broad-reaching impact beyond just publicly traded companies.
Yeah. So then yes, 100% agree. So for all companies, recognizing the increasing importance of this data, what would you say to do now?
So I really would like to leave listeners with 3 tips. First, make sure you're following an established framework. Look at the Greenhouse Gas Protocol. You had mentioned at the very beginning, Heather, you're perusing the 100 or so pages before the call. It's a good idea to kind of look through that and remember what an organizational boundary is, what an operational boundary is, what's a control approach. But reading through that will help you make sure that you're following the spirit and intent of the framework and get to the results that the SEC and other users are expecting. The second piece of advice is data collection. Start now. It is the most difficult aspect and most time-consuming aspect of calculating your greenhouse gas emissions. You're a multinational company, you've got operating in 40 countries, you've got 200 different locations. Getting that data is no mean feat. And this is where technology can really come into play and be handy. Automating the data collection, providing that audit trail so that when time does come for disclosure and the audit, when the auditors knock on the door and say, where did you get this number? You can walk them right back to the original source. That's what auditors are looking for. And then finally, I can't stress it enough. Whether you're doing it on your own or hiring a provider, make sure you're left with a quality, comprehensive, and thorough inventory management plan. Without it, you're really going to be in difficult shape to either pass an audit, or even if the audit requirement goes away, you're still going to be hard-pressed to calculate your emissions the same way consistently year in and year out.
All right. Well, Rich, definitely, those are great tips. And overall, just really appreciate all the insight. I definitely think you helped me understand some of this better. And I'm sure you also helped our listeners. So thanks so much for joining me.
My pleasure.
That does it for today. If you're looking for more ESG resources and to sign up for our second quarter ESG webcast, check out our dedicated ESG resources page at viewpoint.pwc.com. And if you missed today's webcast, don't worry, there'll be another one May 18th. We hope you'll find time to join this important conversation. Join me back here next week for new podcast episodes. On Tuesday, we're continuing our tax toolkit discussion, looking at tax accounting considerations for separate company financial statements. And on Thursday, we're continuing our look at greenhouse gas emissions disclosures, this time focusing on Scope 3. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all the latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.